Hello, everyone, and thank you for joining us. This is Janice. I am the director of the Low Income Taxpayer Clinic at Maryland Volunteer Lawyer Service, and we're lucky to have a great speaker today on a really interesting topic, which I think you will all find very helpful, and we will get to her in just a moment. But first, I want to encourage everyone to follow us on social media. MDLS is up and operational, completely operational. We are still accepting clients and placing clients, so certainly the need for volunteers is continuing and definitely still there. Cheri, if you'll please advance to the next slide.
If I can. There we go.
Great. Okay. Wonderful. As I said, we're still looking, we are definitely accepting new clients, and so we definitely have a need for pro bono volunteers. So for those of you who are volunteers right now, thank you so much for joining us. And for those of you who are not, we certainly encourage you to join us. You can find cases on our pro bono portal, which is on our website here, circled there. Next slide, please, Cheri. Great. And then when you do go to the pro bono portal, this is what it looks like. Our cases are categorized according to the type of legal issue that someone would have, and tax would be the little blue box over there on the far right. So next slide, please. Great. All of our trainings are recorded and available to all of our volunteers, and Cheri also has very graciously agreed to allow us to do this training. So that's going to be available hopefully by the end of the week or early next week. Next slide, please. Great. And if you are, again, if you're not a volunteer, we do encourage that you sign up today. Lots of great benefits like these trainings, as well as access to other trainings. Really a great networking, as well as other benefits, including helping someone resolve an issue that they really couldn't resolve on their own. Next step, please. Next slide. Great. All right. I'm going to let Cheri take over in just a moment here. I just want to encourage everyone who has questions, if you will please put them into the question box. You're welcome to write them in at any time. However, we are going to hold off on answering the questions until the end of the presentation, just so that we don't we keep things moving along. So without further ado, I'm going to let Cheri go ahead and take over. Thanks, Cheri.
Thanks, Janice. So welcome, everybody. I hope everybody's doing well and staying healthy. My name is Cheri Wendt-Taczak. I'm a solo practitioner in Annapolis, and I've been practicing in the area of tax law for approximately 11 years. The focus of my practice is largely tax controversy, representing mostly individuals and small businesses, but I also do some estate planning as well. Today, we are going to discuss a few tax-related problems that I've repeatedly seen in my practice when representing self-employed individuals. We're going to talk about how we can help our clients to avoid and resolve some of these common self-employment tax pitfalls. So self-employed persons represent the majority of businesses in the U.S., not necessarily the amount of revenue, but in quantity. And with the gig economy, their presence in the workforce seems to be growing. Just a little IRS study based on a number of Schedule Cs that were filed with the IRS a year or so ago. They reported that there were, at that time, 25.5 million non-farm sole proprietors in the workforce. So when you combine those sole proprietors with, the others in the self-employed taxpayer population, including LLCs and partnerships and statutory employees, that's a really big population of, small businesses, self-employed individuals. So this group of people, while they may not provide the vast bulk of the revenue within our country, they provide a lot of good and important services to our communities. Construction and accounting, and even people like myself, attorneys, house cleaners, fitness trainers, barbers. So a wide variety of trades and skills. So another interesting tidbit that I had found was that this population of people there are studies out there that say somewhere between 45 and 60%, depending on the study, have reported that the 45 to 60% of self-employed persons do not have college degrees, which I found interesting. So while the self-employed persons may know how to do their trade really well, they may not necessarily have, that accounting or business background to help them really excel on the business side and paperwork side of their business. And so, they either seek the help of a CPA or an attorney to help them with those things, or they just kind of figure it out along the way and may or may not handle it appropriately, right? So, as a result, there's a good chance that things could potentially go wrong, and we're going to discuss a few of those. Specifically, we're going to talk about worker classification issues, payroll tax / trust fund recovery penalty issues, estimated tax payments, and business expense documentation problems. So each of these topics, in and of themselves could be like a huge topic that could require more than an hour each to discuss. And of course, we don't have that amount of time today. So we are not going to do a deep dive into each of these areas. We're going to, do an overview. So at this point, we're going to dive in. So we are going to start out with the issue of worker classification. This is an important topic because both federal and state governments have been working hard for a number of years trying to reduce the amount of worker misclassification in the workforce. And being self-employed is, hard work. You have to run all aspects of the business. It takes a lot of time. And at some point, business owners, sometimes decide that they need some extra help. For this section of the presentation, I just want to let you know that I'm going to be calling the business owner the business or the payor, as opposed to, I know when we get into topics like this, people want to say employer, but that term tends to apply only when you're dealing with a W-2 employee. And since this is a whole discussion about whether they are or not, we're going to use a neutral term, so business or payor. So when the business hires that extra help, he or she, meaning the business owner, needs to decide whether to treat that worker as a W-2 employee or an independent contractor. W-2 employees are provided with certain benefits and protections, worker compensation, unemployment insurance. Currently there's a little bit more leniency with independent contractors with regards to unemployment benefits, but not, typically vacation time, health insurance benefits, and the employer contributes half of the Social Security and Medicare tax that's due on the wages earned by the employee. Independent contractors, on the other hand, are paid a specified amount for their services, and the business doesn't have to worry about any of those benefits or the taxes owed. So self-employed taxpayers sometimes run into problems, misclassifying their workers. This can happen for a variety of reasons. They may do it intentionally to avoid all the extra paperwork, regulatory issues, and the expense of, and headache of having to deal with payroll taxes. Or they may do it unintentionally because they don't fully understand the difference between an independent contractor and a W-2 employee and all the implications of misclassifying their workers. In my experience, the workers don't always fully understand the difference either. They may agree to the suggested classification, or there may be miscommunication between the worker and the business or payor until a time when the worker discovers, sometimes the hard way, that they weren't really a W-2 employee like they thought. And that can happen through an IRS audit of the worker's income tax return, or when the worker files for workers' compensation or unemployment insurance, only to be denied. So for both parties' sake, it's important to understand the classification. a number of problems arise when the business / payor misclassifies its workers. The misclassification can lead to a non-payment of federal and state income taxes, federal and state employment taxes, as well as penalties and interest on the unpaid taxes, backup withholding, in some cases of very bad non-compliance can result in potential criminal exposure, trust fund recovery penalties, which we're going to discuss a little bit later, and workers' compensation issues. So for the business / payor, if audited, failure to properly classify those workers can result in an assessment of thousands of dollars in tax, penalty, and interest, potential jail time. For any business, that's bad news. For the small business / self-employed taxpayers, that could break them. In addition to the huge financial liability that can be caused by the misclassification, the business / payor would likely end up having to spend countless hours dealing with the IRS, the comptroller, the Department of Labor, resolving the error. That's hours that business / payor could be spending generating revenue instead. So needless to say, it's not worth making that mistake, whether it was intentional or not. Problems could also arise for the worker if the worker doesn't know that he or she is being treated as an independent contractor by that business / payor, because that worker may not realize that taxes aren't being withheld and may not, as a result, know to reserve funds, him or herself, to pay those taxes along with the tax return. And that also leads to, that person not knowing that they would maybe be able to claim business expense deductions. So we're going to go to the next slide. We're going to look at the difference between independent contractor and W-2 employees. Part of the difficulty for self-employed taxpayers in knowing how to classify their workers is that there's no single test to define who is an employee and who is an independent contractor. Instead, the various state and federal agencies use similar but somewhat different criteria to determine who is an independent contractor and an employee. In general, the IRS looks to state common law, and there are certain criteria that they look to, and there are three main areas of behavioral control, financial control, and the relationship of the parties. In determining whether the worker is an employee or an independent contractor, the court will look at a whole number of factors, and I'm going to go through a little list here, but they all kind of tie back to those three categories: the behavioral control, the financial control, and the relationship of the parties. So some of the things that the court will look at is the degree of control that the principal business / payor has over the details of the work and the worker, including what instruction was given, about like what and when and how the work is to be done, whether training was provided, what level of supervision was provided, and whether there's employee evaluations that are being performed. The court will look at the investment, whether the worker, who's investing in the facilities and the equipment and the tools that are used by the worker. Also, profit and loss, whether the worker has an opportunity to make a profit or loss, by accepting other jobs and marketing his or her services to other organizations. They also look at whether the principal can discharge the worker and whether the work is part of the principal's regular business, meaning like, is that worker providing a service that is really key to that business? And then the permanency of the relationship, is it a continuing relationship or just a single job? And the belief of the parties as to the nature of their relationship when they began working together. So some best practices / guidance that you can share and use to help your clients would include when working with clients, regardless of what tax issue brought them to your office, or non-tax issue, I guess, if you're not a tax attorney or accountant, would be to watch for some of these indications in the documentation that come across your desk or your discussions with a client as to how that client is classifying workers. And I know this is probably common sense, but the next thing to do would be obviously to educate your client about like the differences between an independent contractor and a between an independent contractor and a W-2 employee, the risk of audit, assuming it's not already been under audit, and the financial impact that a continued misclassification might have on that business. There are several things that you can also do to help your client correct a worker misclassification if one exists. First, there's the question about whether a worker has been properly classified. If so, the business can prepare and file a Form SS-8. It's a determination of employer work status for purposes of federal employment tax and income withholding. This form is a approximately 3.5-page form that asks an array of questions about the different criteria that we were just discussing. And either the worker or the firm/payor can submit that form to the IRS to obtain a formal opinion as to whether the worker was an independent contractor or a W-2 employee. And let's say a disgruntled employee files the SSA, for instance, with the IRS. In that case, the IRS would then also send a copy of that SSA to the firm/payor and request that they complete it. So the IRS gets both sides. So if received, the business/payor should really reply to that SSA request from the IRS, because failure to do so would not necessarily stop the IRS from making that determination, but it would likely result in the IRS making its determination using only the worker's information. It's a good idea, as with a lot of submissions to the IRS, to submit the SSA along with a cover letter, and or an affidavit to support the SSA and to provide some additional information, relevant case law, to support the business's position, as well as any supporting documentation that might be available to support the business's position. So, for example, the firm could submit screen prints of the worker's website, copies of the worker's business cards or invoices, or the worker's business brochures. It generally takes a long time for the IRS to process these requests, but after it does process the request, it will issue a determination of worker status letter that details out, the facts that were considered and its determination. So on this slide, we also have a few other ways that an employer can get, or the business/payor can get relief in a situation of the worker misclassification. We're not going to go through those right now because we have a lot of other materials to cover, but I just want to make you aware of them. So that's the Section 530 Safe Haven, Safe Harbor Relief, the Classification Settlement Program, and the Voluntary Classification Settlement Program. All right, so we are now going to transfer over to problems with payroll tax and trust fund recovery penalty. Employers have a duty to deduct and withhold tax from their employees' wages and to pay that tax over to the IRS. The amount that is withheld from the employee's wages is called the trust fund tax, and it represents half of the Social Security and Medicare tax that is owed. The other half is paid by the employer, so there's an employee's portion and the employer's portion. On a quarterly basis, the employer is required to make deposits of the tax withheld and the employer part, and file Form 941, the employer's federal tax return. And then on an annual basis, the employer is supposed to, file the 940 and the W-3 and the W-2, which goes to the employee as well. problems that occur. Problems arise when the employer fails to pay the employment tax. Employers will sometimes fail to pay the tax because they've misclassified their worker, and therefore they don't think they owe the tax. They think that they don't have to withhold it and then pay it over. And then, at least from my experience, it seems to me that one of the most common reasons for failing to pay the trust fund tax or the payroll tax is due to business financial problems. I've seen a number of instances when I'm working with small businesses where they run into financial problems and they really care about their employees. They want to keep the business going. They want to keep their employees working because they don't want them to be without a job. And so when they're in financial troubles, instead of paying the taxes over to the IRS, they use those funds that have been withheld to pay other expenses of the business to help, keep the business running. So what happens when those taxes aren't paid over to the IRS? Well, eventually the IRS will take notice and begin investigating the problem. During its investigation, the IRS, will most likely pay a visit or two to the business and review business records to help in the analysis of finding out who the culprits were who didn't pay the tax over. The IRS will use this Form 4180. It's a form with a whole bunch of questions that they try to do in an interview. It's usually recommended that you not sit through the interview, but prepare the responses beforehand. Generally, what the IRS is trying to get to is to figure out which of the employees at the business were responsible to pay the tax and did not and willfully failed to pay the tax. So in determining who was responsible, the IRS considers a number of factors, such as whether the employee was an officer of the company or member of the board of directors, whether the employee controlled the company's payroll, had any say in which creditors to pay and when to pay them, participated in the day-to-day management of the corporation, had the power to write checks, and had the power to hire and fire employees. To be considered a responsible person, that employee must also, or business owner, must also have significant control over the corporation's finances. And that means a final or significant word over which bills or creditors paid, but it doesn't mean that it has to be exclusive control. So multiple people can have significant control over the finances. The IRS will consider any person who had the effective power to pay the tax to be responsible. And those conducting ministerial acts, such as those that don't require independent judgment, may not necessarily be deemed responsible. But sometimes the IRS will actually try to get those people who are performing ministerial acts to be deemed a responsible person too. As far as willful, the IRS defines willful to be intentional, deliberate, voluntary, reckless, knowing, as opposed to accidental. And bad motive or evil intent is not a requirement for willful behavior. To show the willfulness, the IRS needs to show that a responsible person was aware or should have been aware of the outstanding taxes and either intentionally disregarded the law or just plainly was indifferent to its requirements. So the failure to investigate or correct management after being notified that withholding taxes weren't paid is enough to satisfy that willfulness element. If the IRS finds that an employee was both responsible and willful, the IRS will then proceed to assess the trust fund recovery penalty against that employee. This essentially means that the IRS is assessing against the employee as a civil penalty the amount of tax that was not paid by the business that's past due, and it's an assessment that will, can be assessed against multiple employees, but the IRS can really only collect it once. So, and we'll go into a little bit more on that in a minute. So. In your effort to help your client with the payroll / trust fund recovery penalty issues, I just have a few things are, proactive guidance versus reactive guidance. So, if there's a situation where your client has not been assessed the TFRP, and you just want to make sure that they're in good order so they don't, get assessed, you can do things such as, make sure that their workers are properly classified so that isn't reviewed by the IRS and they have back taxes that are imposed that they might not be able to pay, and that they do come into compliance with any payroll tax requirements that they have already if they have W-2 employees. Using a payroll service to handle their payroll activities is really helpful, just because it kind of takes that burden off that self-employed person who's already burdened with so many activities, and they can make sure that payroll gets out on time, and the taxes all the tax requirements are taken over by that payroll service. The one thing to be careful about is that they need to make sure that there's enough funds in the bank account to cover those taxes, and I've seen that happen where the business may use a payroll service, but they're trying, but they're not succeeding in making sure that the bank has adequate funds, and therefore the payroll service may drop the service because they're not complying with the terms of the agreement. So I would recommend that the taxpayer, the business, maintain a separate bank account, preferably one that's specifically for payroll payroll use only, but if not, minimally a bank account that's used only for the business, that's not commingling with personal bank accounts, which I've seen a number of times. That will help keep things clean, help them be able to make sure that they can stay in compliance. It's less muddy that way. The other thing that I think is helpful is just, again, going back to my comment about some of these employers who run into these problems and they have a relationship with their employees. One would hope that, because the test for the responsible and willfulness test it can really bring in a lot of people, a lot of unsuspecting employees who don't really think that they're in a position of any sort of power that they should be burdened with potentially hundreds of thousands of dollars of past due, payroll taxes. That these employers, have a talk with them and just make sure that they're thoughtful about who those people are that perform those duties, and make sure maybe that that they explain to their employees the importance of those duties and what can happen if the payroll is not paid out. Because I think there are a lot of people who take on like bookkeeping jobs and they have no clue as to what they're getting themselves into if the business fails to pay their payroll taxes. So on the reactive side, obviously, if the IRS is already investigating a situation, I think it's wise advice to suggest that whether it be you or somebody else, that the business obtain legal representation, and to serve as the go-between and do the negotiation and whatnot with regards to the TFRP investigation and any sort of assessment. And then with regards to collection alternatives, the IRS has 10 years to collect the tax, and as I mentioned already, they can only collect it once. Once the tax has been the TFRP rather, has been assessed, the person against whom it was assessed can actually make an inquiry to the IRS and find out what other persons had been assessed that tax, and they can find out kind of what the balance of the liability is that's remaining. So the IRS will only collect the total amount. If it's $100,000, only going to collect $100,000, even if it's assessed against 3 different people. They're not going to collect $300,000. And you can talk with your clients about collection alternatives. So maybe currently not collectible status, or it just really depends on. That's a whole nother topic. Depending on what their financial situation is. All right, we're going to move on to estimated tax payments. So the self-employed taxpayer's income is subject to not only income tax, but also the self-employed employment tax if their earnings exceed $400, which hopefully they do. The self-employment tax covers the Social Security and Medicare portion of the taxes withheld that would normally be withheld from the employee's pay, but because this person's self-employed, they have to kind of manage that themselves. And in some instances, if the self-employed taxpayer's income exceeds certain thresholds, they also have to pay additional Medicare tax. As we discussed in the previous section, W-2 employees have taxes withheld and paid, but on their behalf, by the employer. But because the self-employed taxpayer doesn't have an employer, they are the employer. They are responsible for withholding their own income and self-employment taxes and paying that over to the IRS. So the self-employed taxpayer has to be proactive in budgeting and paying that tax to the IRS. If the if the taxpayer expects to owe $1,000 or more in income and self-employment tax combined for that year, then they are supposed to make quarterly estimated tax payments to the IRS. Form 1040-ES, estimated tax for individuals, can be used to determine the amount of the tax. And then depending on how the taxpayer's prior year was returned, if in the preparation of the prior year's return, a 1040-ES was prepared, that could actually, it may have already been done for them, I guess is what I'm trying to say. And there are vouchers in that that they can use to submit the payment if they're making a payment by check that they're mailing into the IRS. Payments can also be made online, over the phone, and by electronic funds transfers. So problems. Not making quarterly estimated tax payments, and ending up with a huge unaffordable tax bill the following tax filing season seems to me to be not entirely uncommon among self-employed taxpayers. I don't want to say that this is the norm for all self-employed taxpayers, but I can say that more often than not, when a self-employed taxpayer seeks help, it comes to me with a large debt, there's often a component of late estimated tax payments that is involved. So one reason for this could be that those taxpayers are new to being self-employed and don't really know that they need to make estimated tax payments. But based on my experience to different situations with taxpayers, I'd say that the failure to make those estimated tax payments stems largely just because they didn't reserve the funds to make those payments. In some cases, the taxpayer may have used, again, this commingling of funds. That's just something that just is going to come up repeatedly, but it's important. Using their personal bank account for both business and personal needs, and not being able to maintain separate accounts to keep track of the business expenses causes a problem, because then they don't really know, what their financial situation is with the business and how much they're going to owe. In some cases, the taxpayer's business may be struggling, so funds have been used either to pay business expenses or personal expenses. And I've also seen situations where failure to make that estimated tax payment that first year ends up resulting, in the large bill the next year, and then it leads to a pattern of non-compliance with the filing and payment requirements, and the taxpayer decides not to file the income tax return and the following year because he or she thinks somehow the IRS is not going to notice the failure to pay the tax if they don't file a return. But then eventually the IRS figures it out, and they come after them for the, oops, shoot, sorry, I don't know if you see this, but my battery has suddenly, one sec. I apologize. I thought I was plugged in.
You did the pitfalls of technology.
I had the cord there. It was plugged into my computer. It just wasn't plugged into the wall. Sorry. So, yeah, once the tax is assessed, once the IRS kind of starts coming after that taxpayer and pursues the filing of the returns, and then they assess the tax, there of course there's going to be an imposition of penalty and interest, and then the IRS will begin its collection activity, and if the liability isn't resolved then the IRS will start trying to proceed to impose a levy or file a federal tax lien against the taxpayer, which can adversely impact the credit and potentially have adverse implications for the business. So it's important to resolve the taxpayer's past due taxes, to get them into current compliance with these estimated tax payments, and especially if they want to file an offer in compromise, they have to be in current compliance. It's often times difficult for the taxpayer to make those current payments, but it's really important. It shows good faith to the IRS, and that's part of the deal. They need to come into current compliance. So the longer the taxpayer waits to address the problem, the harder it's going to be to dig out of the deep debt and get back into compliance. So it's just one thing I just really have to. I have a number of taxpayers who kind of groan when I say that they really have to come into compliance, current compliance, but they eventually do it, and they're very happy that they've done it because it allows them to move on and resolve their debt. So a few things with regards to helping your client get back on track with making their estimated tax payments, and if there are any other tax payments necessary. Use are largely, to some degree, going to be repeated and are a little self-explanatory, but just maintaining their records. I think having a good visual of the health of their business. If they keep good records, they can prepare their quarterly profit and loss statements and know how much they're making, so they know they can help stay a little bit on track with how much tax they need to pay to the IRS, so it's not a huge surprise at the end of the year. I would suggesting that they put some funds aside every time they pay themselves, just X%, and again, the bank accounts not commingling, having a dedicated business account. I just can't reiterate that one enough. I've seen a lot of times where self-employed people they're using the same account for both purposes, and it just becomes a mess. And then if the taxpayer thinks that they're going to be earning a notable amount more in any particular year, paying more than what the estimated tax payment says on the voucher is probably a good idea. All right, our final section, deduction documentary dangers. Business expense deductions is another tax-related issue that regularly challenges self-employed taxpayers. The IRS allows taxpayers to deduct certain legitimate business expenses from business revenue when determining their net business earnings for purposes of determining their tax due. IRC 162 governs that and says that deductions are allowed for ordinary and necessary expenses paid or incurred during the taxable year in carrying on a business or trade. Ordinary is defined as customary or usual and of common or frequent occurrence in the taxpayer's trade or business. Necessary has been defined as meaning appropriate or helpful to the development of the taxpayer's business. The courts have also stated that while it's not specified, reasonableness is inherent in the phrase ordinary and necessary, so nothing, out of control expensive relative to the facts and circumstances. And then, while it should go without saying, I need to say that personal, living, and family expenses are not considered a permissible business deduction. The deductibility of IRC 162 business expenses is such an issue that for many years it was actually one of the most litigated issues it was commonly over repeated years, one of the most litigated issues in the National Taxpayer Advocate's Annual Report. And according to the NTA's annual report, the components of that were most litigated had to do with substantiation, whether the expense was ordinary and necessary, whether the expense was personal or business, and whether there was a profit objective. So in order to claim a business deduction, the taxpayer needs to be able to substantiate it. This is very important, and again, it's repeatedly among the most litigated issues in the U.S. tax court, according to the NTA's annual report. I'd also like to note that the taxpayer has the burden to prove that he or she is entitled to claim those deductions for any expense that they've claimed. The burden will shift to the IRS if the taxpayer provides credible evidence, but it starts out with the taxpayer. It's their job to prove that they're allowed to claim it. So the general rule concerning substantiation is found in Internal Revenue Code 6001, is that all taxpayers, even those who aren't self-employed, have to maintain records to substantiate the items claimed on their returns. Records include such permanent books of account or records, including inventories, as are sufficient to establish the amount of gross income, deductions, credits, or other matters required to be shown by such person in any return of such tax or information. I suspect that a lot of self-employed taxpayers don't realize that they need to keep records sufficient to prove not only the amounts of their business expenses, but also the eligibility to claim the expense deduction. And depending on the type of deduction, that could mean a variety of things. There are, the IRC 162 there are other qualifications for certain expenses. IRC 274 expenses for meals, travel, and entertainment. That's a whole different thing with lots of restrictions. We're not going to go into any of that today. But it's important that the taxpayer is aware that they need to be able to substantiate it, and they need to know the components of those expense deductions. So generally, no documentation means no deduction, except for when the Cohan rule comes into play. When a taxpayer lacks documentation to prove the amount of the expense, but can establish his or her eligibility for the deduction, meaning, the IRC 162 test of ordinary and necessary and all that, plus whatever other expenses, expense-specific, any other expense-specific specific criteria that are involved, such as for legal fees or advertising, then the court may, in some cases, allow a deduction and make an estimation as to the amount, as long as the taxpayer's failure to substantiate the expense was not due to negligence or omission, and the taxpayer can provide credible testimony or other evidence showing that he or she was eligible, that they're entitled to some amount of that deduction. So, kind of as an example of that, in one case, the U.S. Tax Court actually declined to use the Cohan rule because in this instance, the taxpayer actually had maintained his books and records, but he didn't produce them to substantiate his business claims. So I think he tried to invoke the Cohan rule or ask the court to do that, but they declined because he had the records. It also should be noted that the Cohan rule doesn't apply to IRC 274 expenses. There are very specific substantiation requirements for that group of expenses that we are not going to go over today. So what problems do our clients run into with regards to expense deductions, substantiation? Well, as business owners wear many hats, our clients are often time constrained when it comes to spending, their own time doing the work that pays the bills versus spending that time to neatly organize documents. I'm betting that most self-employed taxpayers spend their time doing the work to bring in more revenue, and they don't have very much time to do the actual documentation side. Many self-employed taxpayers also just don't understand the expense deduction requirements. Having unorganized or incomplete documentation makes it hard to prove entitlement to certain deductions and potentially hard to even account for an amount of the expense. Again, the burden is on the taxpayer to prove that. Lack of documentation is just going to give IRS leverage to deny the expense and to maximize a potential tax assessment. And the IRS is not going to be likely to try and weed through all your documentation if it's a big jumble of documents to figure out what is applicable or not. And I'm just going to reiterate this one more time. Again, the commingling of bank accounts. I've had numerous clients who commingle personal and business financials. They pay their personal bills directly from the business bank account or from the business credit card, because they feel it's more efficient than like cutting themselves a check to pay themselves, depositing that into their personal bank account, and then paying the personal bill from the personal bank account. The habit makes keeping business records difficult, and if you're working with the IRS on resolving a tax problem, it's going to add to your burden. I'm sure it makes the accountants who are trying to prepare their returns, if they are preparing returns for those clients, a bit of a challenge. So enough on that. Some words on best practices and guidance. These are to some degree reiterating some of what I already said, but it just I think really is important. So educating your clients about the expense deductions criteria will help them to be more effective in handling their bookkeeping. Suggest to them maybe, give them the IRS publications or get, guidance on the different details of the different expenses that they're working with. The instruction portions of the Form 1040 and Schedule C are helpful, but I feel like having more information is probably optimal. Again, maintaining adequate records and just beating into them, so to speak, that they have to be able to prove each element of that deduction. They need to be able to provide, to show that there's a business purpose to that expense. It was ordinary and necessary. It was made in an effort to, in good faith, produce, revenue. So along with the lines with maintaining the adequate records, maintaining, a journal or a calendar or some other document. Credit card statements and profit and loss statements, they're helpful, but they're not adequate on their own. More and more documentation is needed. So that's where those receipts and invoices and the journals come into play. I think it's very helpful. I think it will help the taxpayer in having better control over their business and being able to help with the tax problems or return preparation, whatever it may be, if they get into a pattern of organizing their records, business records, by expense type. And instead of just the big shoebox of receipts or whatever, using something like QuickBooks Online or even an Excel spreadsheet. And then, obviously keeping records, suggested 7 years in case of audit. And then if audited, I would just, ask lots of questions, try and find out if there are documents that the taxpayer hasn't considered that might be relevant to help substantiate their deductions. I find oftentimes taxpayers they just don't have as much of an understanding as to what may be relevant or not. And then again, presenting documentation in an organized fashion that will help improve your case with the IRS, because if it's neatly presented, it makes the job easy for the IRS, and they'll be more willing to see the argument that you're trying to put forth and accept it. So, and that's all I have for today.
Great. Thank you. A lot of good information here, and I actually, to anyone who has questions, please go ahead and feel free to go ahead and write them into the question box. I did want to start off with a comment from one of our listeners, which leads me to a question that I have, and that is that self-employed taxpayers commonly underestimate how much they are taxed. If they're in the 22% federal income tax bracket, you need to add in 15% for payroll taxes, and then another 8% for Maryland taxes. And then they tend to be surprised that 40 to 50% of their earnings are taxed. So that's always a challenging idea for people to swallow. I guess my question to you, Cheri, then would be for someone, and like you said, many times we get these clients who have not paid their back taxes, are now being audited by the IRS, or who have been assessed by the IRS for back taxes. And then, but in order to get them into compliance, you not only have to deal with the back taxes, but you have to be trying to get them to worry about future taxes as well, going forward. How does that all happen? And do they have options for paying their back taxes? Like, can they do an offer in compromise or some sort of collection alternative to help reduce the back taxes? Or are they just going to be constantly running behind until they can earn enough to eventually start being more proactive? It just seems like it's always a difficult thing to tell people. You're going to be owing taxes going forward, but then you still have to deal with your taxes from last year or the previous years, and it just seems so overwhelming to all of them, because they're just all typically, at least our clients, are all struggling simply to stay afloat. And part of the reason one of the reasons that they may not pay the taxes is not only because they didn't know about them, but perhaps they also couldn't afford them in the past. So how would you approach a client like that? Like, what would be the most important facet or factor to look at first, or deal with first, and then going forward, how is this a long-term plan that one would have to work out with the client, or because it's not as if they have the cash to go back and pay the back taxes, nor do they even have the cash to pay their quarterly taxes.
Well, yeah, absolutely. You have to take a holistic approach to it and do a complete financial analysis. You need to do an assessment of how much is due, and then look at the taxpayer's financial situation. Their individual, as a self-employed taxpayer, you're looking at not only their necessary living expenses, but you're also, you have to come into play. You have to look at the business income and expense and all that, because that kind of like flows down right to the personal level, and look at whether they have tax due at the personal level as well as the business level. Because there's some things that could be a little separate, even though the income tax is, passed through and flowed down to them. And really just kind of take all those items into consideration and then have a discussion about the different options. Whether, if possible, I always try and get my client into not close, because then that gives them a little bit of breathing room to try to get their finances in order and either to come into that current compliance, hopefully get them into the pattern of making that, regular current, estimated tax payment, or, their payroll taxes, depending on what issue we're talking about here. But, to give them the breathing room to do that, and then discuss the financial, the collection alternatives that might be available. And that will kind of depend on, how big the liability is, how much time is left on the liability that, that the IRS could collect on, the taxpayers, income, expenses, liabilities, their assets. There's a lot of different factors that go into it. So I always try to take a holistic look at my client situation and try to create an approach for them that will help them going forward.
Mm-hmm. Mm-hmm. And is it more important? If you had to choose one thing to deal with initially in terms of where they're going to be paying their funds, would you advise them to try to focus on becoming compliant for the future, like for the upcoming year, and making sure that they're paying their appropriate payroll taxes and such going forward, their estimated quarterly taxes, and then kind of deal with the rest of their back taxes in some, and kind of focus initially on going forward, and then kind of say, okay, and by the way, we're going to deal with this. But if they had an option where they needed to
you're asking, yes. So you're asking whether if they had a situation that was behind in the estimated tax payments and the payroll taxes, how I would approach that?
Yeah, so I guess, our clients are often stuck because they not only do they owe back taxes, but then going forward, they're going to then need to start making estimated quarterly taxes in order to get into compliance, but they're not making enough to fund both pots. And so is it more important to sort of focus on going forward and then kind of saying, okay, well, we will deal with this back stuff, perhaps as a collection alternative or some other method later. But right now, if you only have so much income coming in, make sure that you focus on the quarterly payments going forward.
Well, I feel like if they didn't have enough money to make, I think if I was to pick between having to pay estimated tax payments or having to pay the payroll taxes, I would advise to pay the payroll taxes, because that tends to be a bigger problem in the grand scheme of things. That said, I'd really encourage my taxpayer, and I'd work with my taxpayer to try and find a way to get them into current compliance as the goal. And if they're in the situation that I feel like you're describing, I feel like they would be probably a good candidate for currently not collectible status, or minimally maybe a 1 year, like an installment agreement, where we negotiate with the IRS for the IRS to allow their current income and expense, and get a lower monthly payment now, and then for the coming year, so they can afford it based on their current expenses. And then, as we go through the year, well, that's some time that we have to assess and kind of figure out what else is going on in their dynamics of their financial situation that we can work with. Do they have a car that they bought a few years ago before they got into this problem, and they're paying $1,000 a month in a car payment, or something like that. Do they have some loan that's going to be coming up in the next year that, that those funds could be put towards paying their estimated tax payments? But I guess it's a little hard to say not having specifics, but I would really try to work, on both. But we really don't, you don't want the trust fund recovery penalty being imposed. That's just a really, really miserable situation. Being behind on your individual, estimated tax payments, that's not good as well. But I feel like the trust fund recovery penalty is even worse. I had a thought, but now it's escaped me.
Well, I think it also brings up sort of a question that you have, or a hard discussion that you might have to have with the client as to whether or not this is something, a feasible business for them, like going forward. Many people become self-employed because they thought it was a good idea, but they didn't recognize all the different consequences and ramifications involved with being self-employed. And
right.
And that, I think, is also challenging, is to understand really what does that mean. Like you said, most self-employed individuals are really focused on earning the revenue and may not really understand all of the business ins and outs of the tax situation, and that can be quite eye-opening for many people. So, unfortunately.
Yes. I've had some of those clients come my way after they've been battered down by Department of Labor, who did a worker reclassification and imposed a whole bunch of penalties and has a liability owed to them, and there's a lot involved in becoming self-employed, and especially if you take on employees. And while there is a fair amount of guidance out there on the web, it just doesn't seem like everything. There's not a nice, neat little comprehensive guide for the average person to read that really gives them everything. And it's rather complex. And there's so many different areas that it can be a little daunting.
Definitely. Well, thank you. It's after 1 now, and I thank you for the very comprehensive overview and the pitfalls. Definitely interesting material and thoughtful things to think about in terms of approaching your next client with this, and trying to break the news gently to them, what they need to be aware of, but definitely important to keep them in compliance so that they're not running into problems going forward if possible.
Absolutely. Yeah.
Great.
Keeping in touch with the IRS, even if you can't. I think if you're staying in touch with the IRS and you're not ignoring them, that helps to some degree. Even if you're struggling to make some payments and stuff, you can keep the dialogue open with them and potentially stave off, that levy.
So yes, so never try to run and hide. Yeah. Definitely. Great.
All right.
Well, thank you. Thank you, everyone, for joining us, and thanks, Cheri, again for a great presentation and
my pleasure.
Very helpful information here. Thanks. All right. Take care, everyone. Stay safe.
All right. Have a great day, everybody. Bye-bye.